Dun, da, da, da. Risk management with options and equities. All right, team. So the theme of this week, we know the theme of the month, it's Discipline December. I'm trying to tailor every single topic and every single lesson around discipline, right? Last week, we talked a little bit about emotion control. We talked a lot about emotion control. This week, we talked about risk management, the golden rule of 3%. We've had a lot of great topics this week, and we're going to finish this week with another great topic, really diving into risk management just a little bit more. We talked about broad risk management, the 3% rule on your account, grading your setups as an A, B, or C, and that's how you take certain trades like a percent risk, 2%, 3%, etc. So I want to talk a little bit more about risk management, particularly related to equities and related to options, not just as a whole, like your account, but actually on the type of assets that you're trading. And today we're going to really just focus on equities and options. And I think you guys get a kick out of this. So let's go ahead and begin. Managing risk with equities. It's easy. All right, moving on. Managing your risk with options. No, I'm kidding. But managing your risk with equities is like so simple, guys. It is so easy. It doesn't really take a lot of brain power to calculate your risk on a trade. So managing your risk with equities is a pretty easy process, and you can master it very, very quickly. You would first start by building your trade plan, right? We always build our trade plan. We apply the 3 A's, and we're going to determine what our entry is, what our stop loss is. Obviously, we're factoring in our shares and our targets, but we're going to look at the entry and the stop loss. So in order to get an entry price and in order to get a stop loss amount, we have to analyze the chart and we have to assess these levels by building our trade plan and applying 3 A's. So once we know what our entry is and our stop loss, we can get an idea of what the dollar amount is on our loss, right? So if we determine our entry is going to be $6 and our stop loss is $5, that means that we're risking $1 per share. So if your stop loss is indeed $1 and you take 1,000 shares, your stop loss would be $1,000, right? $1 share stop times 1,000 shares equals $1,000. It's that easy, guys. It's simple multiplication, right? Determine how much per share you're willing to lose, and then multiply that by your share amount to get your stop loss amount. So it's per share risk times your share amount equals the dollar loss. So let's do a different on the spot example, okay? If you're risking $2.20 and you have 1,000 shares, what's your risk? Hit me with it. You don't need a calculator. If your stop loss is $2.20 on the chart and you have 1,000 shares, what's your stop loss? I know it. Boom, it's in my head. All right, so again, you got 1,000 shares, you're risking $2.20 a share. What's your stop loss? Yep, $2,200. All right, now you have 1,000 shares of the trade, you're risking 50 cents. All right, what's your stop loss? Same scenario, 1,000 shares, now your risk is 50 cents. How much are you risking on the trade as far as a dollar amount? Remember, it's your per share risk, 50 cents, times the share amount. Not 500, guys. Nope. Wait, hold on. You're right. I completely butchered that. Yes, you're right. You're risking 50 cents a share. At 1,000 shares, you're right. It's $500. I did the math backwards. I meant to cut the other thing down. Anyway, it's all good. But you're right. Yes, it's 500, right? So it's that easy, guys. It's that easy. It's just on the spot math, right? That's how I can calculate my risk on the spot, right? Because if I know, I'm like, all right, I'm taking 1,000 shares, risking $1, it's $1,000. I don't want to lose $1,000. I want to lose $500. So I got to cut my position in half, right? Take 500 shares and risk $1, Or I can keep my 1,000 shares and risk 50 cents and still put myself around a $500 loss. I'm able to think about this stuff on the fly. So we all know how to manage our risk with equities. Managing risk with equities is very, 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 very easy, right? It's the per share risk times the share amount, and that's going to equal your dollar loss on that particular trade, right? Manage your risk with equities, very, very easy, and it can be mastered very, very quickly, which I'm sure everybody has mastered it very, very quickly. And the more you do this with repetition, the more you do this math in your head, you're going to be able to make these adjustments on the fly in the moment and still make sure that you're not putting yourself at a larger risk than what you should be risking, correct? Because we know we have a $10,000 account. You're going to risk 3%. That's $300. If your stop loss is $1 a share, that means you can only buy 300 shares. Because if you have 300 shares times $1, that's $300. And $300 is 3% of your $10,000 account. So boom, you just managed your risk with equities. And you also managed your risk in conjunction with your account size to keep things clean, to keep things equal, right? So it's very, very easy to manage risk with equities. Talk about managing your risk with options. Now it's time to make your brain hurt. I said you'd probably get a kick out of this. Managing risk with equities is really simple. Managing your risk with options can be a bit more challenging to master, right? It took me a while to actually figure out how to properly manage risk with options. I'm like, it's just so random, right? It's so random. I could buy a call. What's it going to go up in value? What's it going to go down? Like, how do I properly build a plan around an option? How do I manage my risk? It took me a while to actually figure this out. To be honest with you, made my brain hurt. So I'm going to make your brain hurt today. So options can be a bit more challenging to master when managing risk, but we make it simple and we make it easy. You can take all of the options data. So all of that options data that you see, delta, the theta, etc. You can take that options data and you can, in a sense, overlay it on your chart. So imagine having a chart, having a transparent options data something. You could literally just take it and overlay it on the chart, and you can manage your risk that way. You can overlay that on your chart to get a very, very good idea of what your profit and loss on an options contract is going to be. So how do we do that? How do we take this options data, right? These Greeks, all of these variables that dictate what an option is going to be worth now or in the future if the underlying asset moves, right? How do we take that data and overlay that on our charts? Well, we first have to understand the two most important Greeks, right? We have to understand the delta. We have to understand the theta. So the delta is the dollar amount the options contract will go up or down for every dollar the underlying stock moves. Okay, so I'm going to say that again, and you can write this down. The delta equals the dollar amount that the options contract will go up or go down for every dollar that the underlying stock moves. Example, Roku is a $250 stock. Right now at this point in time, Roku, let's say it's $250, which it's actually right at $250. It's $250. And let's say you buy a call for $1. That is $100. That's a $100 investment. And it has a delta of 0.30. That is $30. So you're buying a call for $1, and it has a delta of 30 cents. Right? So you're buying the contract, that call for $100, has a $30 delta. If Roku, the stock, goes up $1 from $250 to $251, the options contract would go up by $30. Remember, the delta is the dollar amount that the option will go up or down for every dollar that Roku moves. So if you buy a contract for $100, has a $30 delta, and Roku goes up $1, your options contract would be worth $130, right? If Roku goes up another dollar, your contract would be worth $160. Roku goes up a full $3. Your options contract would be worth approximately $190. Okay? Now, if Roku goes down $1, right? Same scenario. Roku's at $250. You buy a call for $100 and has a $30 delta. If Roku drops $1 to the downside, that options contract would lose $30 of its value. So it would go from $100, it would go down to $70. That's 30%. Like, wow. I could lose 30% of my investment, and Roku would only have to drop $1. That is way under a percent. So literally, Roku could move $1, right? Roku could move 1%, but your options contract could move 50%, 60%, hundreds of percents, right? So again, the delta is the dollar amount that the option will go up or down for every dollar that the underlying stock moves. All right, works both ways, to the upside, to the downside. Right? Now, there's more to that. Okay? I'm trying to keep this simple. So for every dollar that Roku would go up, your delta would be increased. So if Roku goes from $250 to $251, the new delta may be $32. Right? Now, if Roku goes up another dollar, make $32. Now, the new delta may be $40. Right? Roku goes up another dollar, the new delta may be $40. So technically speaking, on a call, and Roku's going to the upside working with you, every dollar that Roku moves, the delta is going to increase as well. So it won't just stay at 30 indefinitely. It'll go to like 35 and 40 and 50 and 60. So at some point in time, for every extra dollar Roku moves, you could be making $60 per dollar, right? Because it's going to increase as the stock's price goes up on that call, okay? Now, to the downside, the delta would actually decrease. So that means on the first initial drop to the downside, that $1 move to the downside, you're losing that $30 because that's the delta. But the new delta could be 20. So the next dollar drop to the downside, you wouldn't lose $30, you would maybe lose 20. Right? Now the new delta is, say, 10. If it drops another dollar, you're not losing 30, you might be losing 10. So the delta will fluctuate, the delta will change as the stock's price changes. I can show you guys an example of this here on an options chain. If we go to like just the SPY, right, we can see how the delta changes, right? 45, 36, 26, 18, and 12. So if you bought a 469 call and the SPY goes down $1, you lose 45 bucks, right? But now you're right around this delta, right? So if it drops another $1, you're not losing 45, you're losing 35. Drops another $1, you're losing 26, approximately. Drops another $1, you're using 18. So it's not like you're going to lose $45 for every dollar that drops. The delta will be decreased. Just like to the upside. On the first dollar move to the upside, you would make $46. On the second dollar move to the upside, maybe 55. On the third dollar move to the upside, 63 and 70 and 76 and 81. So the delta varies. The delta will move as the underlying stock moves as well, okay? And that's very important to know, because if you're going to risk, say, $3, you can come in here and get the average delta over the closest three strikes. And you can get an idea of what the average decline or the average loss will be per dollar that the stock moves against you, right? Same thing to the upside. You know that the delta would increase. So you can come get the average delta to get an idea of what that may be as far as taking profits. So I hope that makes sense. If it doesn't, please speak up. I would be more than happy to go back through that. But I hope it makes sense. That delta will vary. It will go up and it will go down. And you have to just go look at the options chain to get an idea of what it will increase to or what it will decrease to for every dollar that the stock moves up or down. Okay? So that's delta. Dollar amount that the option will move, right? The dollar amount that the option will go up or down for every dollar that the underlying stock moves. The next very important one is theta, right? Theta equals time decay, right? So remember, with options, you have time working against you. not with you, right? The theta amount is how much your options contract will go down for every day you hold it. So the theta is always a negative number. It's always a negative number is the theta, okay? So the theta, again, is time decay. You have time working against you with options. The closer to expiration you are, the higher the theta is. So normally, the day of expiration, the theta is the value of the options contract. Because at the end of that day, that contract will expire most likely out of the money for $0. So the day that the option expires, you'll notice that the theta is normally the exact same as the premium for the option, right? A day before, maybe 80%. Day before that, maybe 60%. But the closer you get to the expiration date, the higher the theta becomes. And the theta is how much you're going to lose simply by holding that option for a full trading day or holding it overnight. Okay? So example, Roku is at $250. And you buy a call for $1, which is $100, and has a $30 delta, okay? And a $50 theta. Right, now we're adding the theta in. So the same example as before, right? It's $1 for the contract. The delta is $30, and the theta is $50. Let's say you bought that Roku call Monday morning and held it into Tuesday morning. If Roku set flat all day, so let's say you bought the call for $1, for $100 when Roku was at $250, and let's say you did that Monday morning right when the market opened at 9:30, and let's say Roku set at $250 all day. It just set at $250 all day. It didn't budge a penny. In the equities world, you would be what's called break even, right? With equities, you buy a share at $250. It's at $250, you're break even. With options, you're actually going to lose money. That's your theta. Again, Roku could have sat flat all day Monday and never moved a penny in price. With equities, that is a break even trade. However, with options, you are losing money from the theta. In this example, you would lose that theta of $50, even though the price is exactly the same. So you would have lost $50 if the theta was $50. So you would have bought the contract for $100. It didn't move a penny. You held it until Tuesday morning. That options contract would be worth roughly $50. You would have lost 50% of your money just by holding the stock into the next trading day, assuming the stock did absolutely nothing. That's kind of crazy to wrap your mind around. There's a lot of variables when it comes to options. It's not as easy, right, to manage your risk with options. It's not straightforward. $1 a share, 1,000 shares, $1,000. Easy peasy. Here, we have to look at the delta and how the delta is going to fluctuate to the upside, to the downside. We have to take in consideration the theta, how that can fluctuate for every day we hold it close to expiration, right? But you always got to ask yourself, are you day trading or are you swing trading, right? If you are day trading an options contract, you're probably holding it for 20, 30, 40 minutes, right? Maybe 5 minutes, maybe 10, maybe 20. It's a day trade. You don't have to put that much emphasis into the theta because the theta is not really going to impact the contract that much on a day trade. You really need to put more of your focus on the delta. The delta is really where you need to put your focus to get an idea of what your profit's going to be and to get an idea of what your loss is going to be. Would the delta be a little less than the next day because we are a day closer to closer to expiration? Would the delta be less? Let's look. I don't know. I don't know how the delta moves. I know the delta moves based on the gamma, right? The gamma represents how much more the delta will be on the next dollar move. So for example, You look at the 469 strike on SPY for tomorrow. The delta right now is 47. The gamma is what the new delta will be if the SPY goes up $1. So add 9 cents to 47, you get 56. Right? Same thing. Right? If the SPY goes up another $1, your new delta will be 9 cents higher. So 56, 55, plus 9, puts you right around 64. So the gamma, you add to the current delta to get your next delta. You add the gamma to the delta to get your next delta, so on and so forth. It works the same way to the downside, right? If you see this has a 27 delta, if the SPY drops $1, your new delta will be 8 cents less. It'll be 19. So I don't know if the delta will fluctuate based on time, but I know it fluctuates based on gamma, right? And the gamma is going to be calculated based on the dollar move of the stock. And that's how the new delta is calculated, whether that's to the upside or whether that's to the downside. Even if we go back and look at 4 days until expiration on the SPY, let's put this in perspective, right? Let's put this in perspective. We're going to look at a 469 call for tomorrow, and we're going to look at a 469 call for Monday. The 469 call has a $45 delta for tomorrow. Going out until next Monday has a $39 delta. Going out 6 days, it has a $47 delta. Going out 8 days, a $47 delta. Going out 11 days, a $47 delta. Going out 13 days, a $44 delta. Going out 14 days, a $48 delta. Going out 18 days, 45. Going out 20, 45. So with that being said, no. That being said, would the delta be less? I don't think so. Because going out 20 days, right? Going out over 2 weeks on the SPY at the money is right at 45. So remember, the delta is not just the dollar amount. The delta is also a percentage chance that that option will expire in the money. So not only is that $45 for every dollar that the SPY goes up or down, that's also the percentage chance that this is going to expire in the money. There is a 45% chance that this will expire in this blue box up here, this purple shaded box, right? Right here. There's a 51% chance that this is going to expire in this blue box, right? So I know it represents a percentage as well as a dollar amount. So I don't know if it's going to change the closer to expiration. It's only going to change for the dollar movement. The closer to expiration or the further to in the money or out of the money, depending on where you're at. Deep in the money, deep out of the money, or at the money. Based on where you're at compared to being an at the money, that's what's going to make the delta. Not necessarily time, but based on where that option sits in correlation to the at the money price. Okay? Close all these windows out now. Gee. There we go. There we go. All right, where'd we leave off? Yes. So what we were saying is day trading, right? When you're day trading options, you really just need to focus on the delta, right? The delta represents what you're going to make or lose for every dollar the stock moves, right? The underlying asset. The theta is not going to have that much of an impact on a day trade. Now, if you're swing trading, right, you really need to put emphasis on the theta. Because the last thing that you want to do, buy an options contract for $100. The theta be $80, but the delta be $20. So I'm going to break this down. So let's say you bought a contract for $100, right? The theta is 80, right? And the delta is 20. This is the swing trade. Remember, day trades, we don't have to put that much emphasis on theta. Theta is really not going to impact our day trade, all right? The theta will impact the swing trade. So let's say this is Monday, and you're going to hold it into Tuesday, okay? On Monday, the stock's price was $200, right? On Monday, the stock's price was $200. On Tuesday, the stock's price is $204. right? In the equities world, you would be up $4 per share, correct? If you would have swung trade a stock at $200 on Monday and it's at 204 on Tuesday, you would be up in the equities world $4 a share, right? $4 a share. That's what you'd be up. Let's break this down on options just to show you guys why it's very important to understand these variables and how to do math to get an idea. So same example. You're swing trading a stock, $200 on Monday. It's worth 204 on Tuesday. That's up $4 a share. Let's break this down on the options contract. You paid $100 for the options contract, okay? Just for holding it overnight, you lost 80 bucks. So now the contract is worth 20. But the stock did go up $4 a share. So it'd be $20 times 4, right? $20 for every dollar the stock moves, it moved $4. So $20 times 4 equals what? 80 bucks. That puts you back at $100, give or take. Remember, this is an approximate. So literally, if you would have traded equities, you would have made $4 a share profit. On this example, if you would have taken an options contract, you would be break even. So literally, the stock's price could be going up and the trade could be working in your favor, but you could still be losing money. It's absolutely insane. That's why you have to understand these things. If the theta outweighs the delta on a swing trade, do not take it. You always want the delta to outweigh the theta. You wouldn't want to see these roles changed. You would want to see the switch, right? You always want the delta to be at least 3 times greater, right? In my opinion, at least 3 times greater than the theta. You always want the delta to be higher than the theta. So in this same example, right, the same exact example, if you would have been smart, understood that the delta needs to be greater than the theta on a swing trade, that same example started with $100 on Monday. Stock went up $4. Okay, the stock went up $4. So the delta is now 80. So that's times 4, right? What's 80 times 4? It's 320, right? 320. Okay, so boom. It went up $320. Right? So boom, that is 420 bucks. You have the theta minus 20. You held it today. Boom, 420. That would have been your profit hypothetically on that example. So that's where I went wrong as a new trader a lot of the times. Not understanding how impactful that theta is. And not understanding there has to be a ratio between delta and theta for swing trades. Because I was taking all these swing trades. The trades were up, but I'm break even. I'm like, fuck, break even? Stock's up $5. I never once thought to look at the theta. Right? When I go back and look in hindsight, the theta was most likely much higher than the delta. So the theta and the time decay was so powerful that even though the stock was moving in my direction, I wasn't able to get enough movement to offset the theta. The delta always needs to be 2 to 3 times greater than the theta, okay, if you're swing trading stock. That's just my recommendation, that the delta times 3 on the theta, right? There's my little math. The delta times 3, and the 3 is the theta. So you always want the delta to be 3 times greater than the theta. Is my math off? Did I fuck up again, guys? Did I fuck up again on my math? I don't think so. Right, same example, right? You have a $100 investment. Stock goes up $4 overnight. $80 for every dollar that the stock moves. That'd be $80 times a $4 move. That's $320, right? That's $320 minus the theta is 20. I was off. You're right. 300. You had 100. My math was off. It's not 420. It's 4. I just like 420, guys. Yeah, my bad. That's called dyslexia, right? You guys know what I mean? You guys know what I mean. If not, make me feel stupid because my dyslexia is really bad sometimes. All right, so we're on the right page. But you guys get the point. You guys get the point. All right. All right, so I have a little bit of a I would call it maybe like a workshop. Not really a workshop, more of a an interactive segment of the lesson, right? I would say interactive segment of the lesson where I want you guys to use your brains, and I want you guys to determine what your stop loss and profit would be based on these upcoming examples. So again, we're using this example here. So let's say you see a cup and handle forming, right? So you see a cup and handle forming, and you're going to buy a call option, right? You're going to buy a call. When the stock's price is at $200, you're buying a call, okay? Based on the chart, your stop loss is $195. So if the stock comes down to $195, you're cutting it. That's a $5 loss. You're losing $5 per share. You have a target of $210. So if target's hit, you're making $10 per share, okay? So you built your plan. You have a cup and handle, built your plan, right? Entry, stop loss, target, and you're going to go ahead and buy a call option versus shares. So the call option, let's say, and write this down, I want to get you guys involved. Let's say that you're paying $10 for that call option. Stock's price is $200. You're going to buy one call option. One call option. And you're going to pay $10 or $1,000 for that call option when the stock's price is at $200. You have a delta of $1. It's $100, right? The delta is $1 or $100. And the theta is 50 cents or $50, right? So that's your trade. Cup and handle, buying when the stock's price is at 200. You're going to sell when the stock's price gets to 210. That's a $10 per share move. And your stop loss is $5 under your entry at 195. You bought one call option. You paid $1,000 for it. You have a $100 delta, and you have a $50 theta. Example number 1 is a day trade. What is your profit and what is your loss based on this example? So again, this is where you write this down and you answer. I want this to be interactive, okay? So example number 1 is a day trade example. If your target's hit and your stop loss is hit, okay? What is your expected profit on this trade? And what is your expected loss on this trade by simply using delta and theta? Correct. So your profit based on this example would be $1,000. Your stop loss on this example would be $500. So 100% correct, right? Because the delta is $100. And you have a profit target $10 higher. So 10 times 100 is 1,000. Okay? Now the theta is $50. So it's not $500, Corey. So you almost got me there. The theta, oh wait. We're not applying the theta. My bad. You're 100% right. The delta, 100 times 500. You're correct. My bad. In a day trade. I saw overnight swing trade example. That's my bad. All right. So yes, you're 100% correct. 100% correct. So it is $1,000 of profit and $500 of risk, because as day trades, remember, we put more emphasis on the delta. The theta doesn't have that much of an impact. So let's say example number 2 is an overnight swing trade. Same numbers, same call option, but now we're adding in the theta. The theta is $50. So example number 2 is an overnight swing trade. What is your profit and what is your expected loss if you were to hold this overnight? 950, 550. That's correct. So it's the same thing, right? On a day trade, you're going to make $1,000, right? And you're going to lose $500. So the only variable that changes is the overnight variable. What's the overnight variable? Theta. What's the theta? $50. So you take the same example from example number 1. Take the same example 1, day trade, right? We just determined it's $1,000 of profit, $500 of risk. The only other variable is the theta. If we hold this overnight, we're going to lose $50. So now our profit would be $950. Our stop loss would be $550. So 100%. 100%. But again, these things change. These things change a little bit. The theta is going to fluctuate the closer to expiration that you go. The delta is going to fluctuate for every dollar that the stock moves, right? And you have other variables as well. You have to be mindful of what's called the implied volatility. The 50's coming off no matter what. Even if it's flat, the theta's coming off 100%. The theta is every day you hold the contract. So you're always going to lose money on the contract. Even if the stock is flat, you're losing money because of the theta. Okay? But there's other things that you have to be mindful of, right? What are some of those things that you have to be mindful of? What's some criteria that I really look for when making options trades, right? What's some criteria? Well, one criteria is the spread less than 5%. Imagine there being a 20% spread between bid and ask, and you were to buy that option. That means you're immediately down 20% on the contract. So if you would have invested $1,000 and the spread is 20%, you're immediately down $200 on that contract. So one of my pieces of criteria is spreads less than 5%. That means if you enter a trade with a spread less than 5%, you're only down 5%. You're able to manage your risk better. You're able to apply that 5% in to your risk. All right? The spread needs to be less than 5%. We just talked about this. The delta needs to be 3 times greater than the theta for swing trades, right? 2 minimum, 2 times greater minimum. But in my opinion, the higher the better. I like 3 times greater. I always want to see the delta at least 3 times greater than the theta for me to feel very confident that, hey, I'm going to take the swing trade on options, not take the swing trade on equities. The IV, right? The implied volatility. Ideally, I want to see this under 50%, right? Because the implied volatility is the expected amount of volatility of that options contract over its life. The higher the IV, the higher the premiums are. The lower the IV, the lower the premiums are. So if you bought an options contract when the IV was at 50, and let's say the IV the next day is at 100, and the stock's price did nothing, that options contract would still most likely be worth more money because the IV is increasing, and in return, the options premium increases. But let's flip this scenario. Let's say you buy an options contract when the IV is at 200%, right? Let's say the next day, the IV is down to 50%. This is what we call an IV crush. There is a term for this, an IV crush. It's when you buy an options contract with a high IV and the IV drops substantially, bringing the value of the contract down. I can't tell you how many times I've been in a call. I didn't understand IV. I've been in a call. Stock's ripping and running that day. It's up $1, $2, $3. I'm like, fuck yeah. Lunchtime hits. It's leveling off. It's choppy, right? It's moving. It's volatile. It's moving, but it's not parabolic, right? It's more consolidating. It's more range bound, right? For a few hours. Boom. I'm down on my my option. I'm like, what? I was just up 200%. The stock is still holding this level. I don't have to worry about the theta. The theta shouldn't impact my option that much. What's going on? Volatility shifted. The volatility died on off, right? On the stock, the volatility, the IV dropped on the option. I experienced what's called an IV crush. I didn't realize the IV being 200% was meaning I was paying a lot more of a premium for that contract. I was paying much more than what it was worth. And then when the IV came back down to reality, 50, hypothetically speaking, I experienced what we call an IV crush. I was still green on the trade. I was still up on the trade, but I experienced an IV crush. The IV dropping substantially like that as the volatility died down. I lost a good chunk of change. I didn't know that. So you got to be mindful of the IV. You want to be a buyer, the IV's low. You want to be a seller when the IV's high. Not saying that's your strategy to go out there and buy low IV contracts and hope to sell them when the IV's high. I'm not saying that. What I'm saying is it's ideal to be a buyer with a low IV. It's ideal to be selling with a high IV, right? because with the IV is high, the premiums are increased and you get more bang for your buck. You get more of a premium. You get more profit out of it. All right. And then high volume and open interest. Okay. So just like stocks, we really want to focus on the ones that have the most amount of volume and the most amount of open interest. Okay. So when you're just looking at an options chain, you just want to make sure you have open interest in there, and implied volatility, and you want to actually have your volume as well. You just want to look at the ones that are trading the most volume and the most open interest. So right here, you would be okay with going with like a 470, right? A 470 SPY call. 77,000 contracts traded. That's the highest volume count, and 24,000 is the open interest, right? It's one of the highest. So this wouldn't be a bad options contract to get involved with. The 470. The open interest is high. The volume's high. The spread is a penny. The spread is nice and tight. The IV is low. If we go back in here and add the implied volatility, you can see the implied volatility is 15%, which is fantastic, right? We can go back in here and look at the delta. See the delta is a 40. The theta is a 93, though. Wow. So put this into perspective. Let's say you wanted to swing trade SPY falls into tomorrow, right? Imagine the SPY not doing anything today, sitting flat. You're going to lose $100 just to hold this until tomorrow. So even if you hold this into tomorrow and the SPY gaps up $1, you're still losing money because the theta is outweighing the delta. This is no bueno, right? This is a no bueno swing trade. You would not want to swing trade the SPY overnight because the theta is outweighing the delta, right? You're going to take more of a loss than what your gain is unless the SPY gaps up $3. The SPY would have to gap up or move $3 to get back into the green because the theta is so high. So you want to always find the theta less than the delta. If you want to find a theta less than the delta, you have to go further out on your expiration, right? The further away from expiration you are, the lower the theta is. Okay? So again, team, that is pretty much the lesson. That's the topic. We know what risk management is. We talked about this on Tuesday. We know what the golden rule of 3% is. We know how to manage risk on equities. We know how to build trade plans, right? We know how to do all of this, right? I'm sure that 100% of you guys are confident in reading the charts, building plans, assessing all of your levels, right? Understanding what your risk is going to be, your position sizing. I'm very confident you guys know how to do that, all right? But when we're managing risk with options, it's a lot more challenging, right? There's more to it. You have to look at the delta and how the delta moves. You have to look at the theta and how the theta moves. You have to be mindful of spread, right? The time decay, the fluctuation. There's a lot of variables with options that make it more challenging to manage your risk. But we try to keep it very, very simple. And I hope I was able to break this down in a way to take something that can be challenging and confusing to make it simple and easy. You're taking this data, right? The delta, the theta. You're taking this options data, those variables. You're simply taking that data and you're laying it over the chart. And based on those variables, based on that data, you can get an idea with some simple math on what your profits and what your loss is going to be. It just takes a little bit more brain power. It takes a little bit more time, right? You have to do some extra math. But at the end of the day, it's doable. It's achievable. And when you do it a lot, right, consistently, it becomes very, very easy. I can look at an option and at first glance know if it's good or bad, right? I know approximately off the top of my head, just like that, profit and loss, because I've looked at it and I've done this so many times. It's just a natural instinct, okay? So do we have any questions about, primarily, I guess the topic of the lesson is managing your risk with options? Does this make sense to everybody? Does this kind of open up your eyes a little bit and make it easier to now go in that options chain to pull this information out, to go back to your chart, to get your numbers? Get your numbers. And the reason why buying weeklies at the end of the week is because the theta, right? The theta has such a strong impact. Now, as day traders, as someone that's going to be in a trade 5 or 10 minutes, the theta doesn't make that big of an impact, right? The theta doesn't make that big of an impact on a day trade. But if you plan on a 5-10 minute trade and it starts being a 1 to 2 hour trade, now you got to be very mindful of the theta because now it's starting to impact your weekly option. Angel still doesn't like options. Hey, listen, man, we're on the same page. I just trade my equities, right? I trade equities. Per share risk times share amount equals dollar loss. Easy peasy, right? So simple. So simple. Options. Delta times theta, subtracting the go-to Roku to the moon, example AB squared times pi, right? And then once you get that number, you divide it by the moon ship times, dude, it's just, there's a lot, all right? I'd rather short, I'd rather take equities, but again, there are opportunities with options, okay? There's an abundance of opportunity in the options world. Swing trading, longer term swinging, day trading, hedging, right? The stock can move 1% and your option can go up 100%. The stock can move 10% and your option goes up 1,000%. So there is opportunity in the options world. And that's why I want to take the time, even though I don't trade options full time, I want to educate you guys on options because maybe you come to find out that, hey, you're a better options trader than you are equities. Maybe you like options. Maybe you like trading small amounts of money and making big returns. I still want to take the time to educate you guys on things, even if I don't utilize those things. Indicators, strategies, options, things like that. Austin, what's up, buddy? Yo, Glenny Trade said, I was told there would be no math. No math. Does the gamma affect the theta same as delta? I honestly don't know. I honestly don't know. Dr. Egg? I mean, I don't know everything. I don't know if the gamma affects the theta like it does the delta. I do not know that. Maybe. I'm not sure yet. Maybe Friday night. It'd probably be Friday night. All right, cool, guys. Well, that was it. That was a quick little 40-minute breakdown on really just managing your risk with options. I don't even know why we said equities and options. I mean, the equities part was like super easy. I'm sure all you guys are like, dude, like I already know how to do this. What are we doing today? But managing your risk with options, that's important. I know a lot of you guys are dabbling with options. You're starting to trade the SPY. You may start swing trading. I think this is a great time, and it blended very well with our theme of the week and with the theme of the month, discipline. Okay, guys, so now you have some more information. You have more knowledge to start applying this, especially if you're going to start dabbling more with options for day trading and with swing trading as well. All right, guys? So that wraps up our